Thank you all for joining me today. And today's topic is investing for dividends, that is dividend investing. Now, what are dividends? I know some of you know what dividends are. I know you've come across the word dividend. But in essence, dividends are what a company shares to their shareholder when it makes profit. So there are companies that decide to share part of their profit with their investors, and that's what's called dividends. Now, dividends by itself is a broad term, and you find other people call it passive income, other people call it whatever it is that they want to call it. But in essence, by definition, dividends is just what a company chooses to share with their investors or shareholders when they make profit. Now, companies are in the business of making profit for the most part. All they do is create products or services that they sell to customers, and when they make profit, the company either grows with that profit or the shareholders grow because of that profit. So company like Microsoft making softwares, Windows softwares among others, what they want to do is provide value to customers, and then these customers pay them in terms of cash. They take this cash, they use part of that cash to develop new softwares, new applications, stuff like Office Suite, stuff like Microsoft Teams, where you can do conferencing. They do a lot of developments with that profit to then provide new services and softwares to customers. And then when the customers buy these new services, they pay them back again, and the cycle keeps going round and round, where they make profit and they use that profit again to make new programs. Now, other than just using the profit for new programs, they use the profits for paying for other costs, the costs of development, salaries, and other benefits to their employees. And then after everything else is done, and they say, okay, we still have a little bit more money, what they do is they take that money and say, we want to appreciate our shareholders by sharing this part that has remained to them, so that they can also have something on the side. That is, yes, we are making profit, we are happy that we are making profit, but we can also make our shareholders happy by sharing the profits that we get from the businesses that we do with our customers. So as a shareholder, your aim is to invest in companies that offer dividends, because at the end of the day, if a company offers dividends, it's a good way to show that they care about their shareholders. They care about the company's growth and performance. They are focused in improving day to day. And when you find a company that also does increasing dividend growth over time, that shows you that they're even more committed to provide more or give you as a shareholder a little bit more every year or every quarter than other companies would have done it. So a company that gives dividends or gives increases their dividend payouts every quarter or every year is a good company to invest in. And you as a shareholder, you need to be focused on getting to invest in these companies. So that's what companies do, and what is referred to as dividends in terms of what a company offers, which is they share their profits with their shareholders, and that's what's referred to as dividend. And you as an investor, when you buy stocks or ETFs, now you go buy these companies, because these are companies that are more stable, more growth oriented. They offer dividends which could double your compounding growth in the company. So you buy 10 shares today, but you're getting $10 in dividends. That $10 will go back to buying more shares, and therefore keep growing your investment. So what is dividend investing? Essentially, that is, you're buying companies or stocks that offer dividends, and then you use part of that dividend for your income, or you can reinvest the dividends to grow your account or your investment over time. Now, why should you invest in dividends? I think I've touched on this before, that you invest in dividends if you're looking to earn passive income. So if, say, you know your monthly expenses is around $200 or $20K, then you can say, I'm taking part of my earnings today, whatever I get from my job or from my business, and I'm putting it in this company, and I'm doing this to earn around $200 in dividends, or 20,000 Kenyan shillings. And that 20,000 Kenyan shillings will now be considered as income, where I can use that 20,000 Kenyan shillings to take care of my needs, my basic needs. So that if I lose my job, I have 20,000 that will take care of my needs, and then I can figure out what to do from there on. So your rent is taken care of, your food and other necessities are taken care of, and your daily expenses, transportation and the likes, have been taken care of. Now you're left with, you have an income, but your money is working for you to earn you that income. You're not going out to do business or work at a job to earn that income. That's what passive income is. And that's why one of the reasons as to why you should invest in dividend, you should do dividend investing, because it takes care of your needs income-wise. Now, the other reason as to why you'd want to invest in dividends, like I said, is you want to grow your investment a little bit more faster than normally it would have grown if you just, took out the dividends. So let's say the growth rate with dividend investing, which is a dividend reinvestment plan, let's say the growth is 20%. But without dividend reinvestment plan, the growth is 15%. Now, if you reinvest your dividends, you're earning 5% more than if you didn't reinvest your dividends, which makes a huge difference when you're doing compounding, because with compounding, that 5%, if it's 5% a month or 5% a year, can make a huge difference in a long-term frame. So if you're looking at investing for 5 to 10 years, 5%, say a month or 5% a year, can make a big difference. And that's the reason as to why sometimes you do dividend investing, because when this dividend comes in, it changes how much your account can grow over time. So that's the second reason as to why you should invest in dividend companies, or you should do dividend investing. The other reason is you want the freedom that comes with knowing that you have passive income if you need it. You want that freedom of knowing that if you get laid off, you don't have to go and get a desperate job just to take care of your needs. You have that sense of security, knowing that even when you retire, like you're retiring and you know your retirement benefits are not going to take care of you adequately. Investing in dividends or dividend companies will give you that sense of security and sense of knowing that down the line, if something goes wrong, I can convert my dividends from reinvestment plan to income plan. and vice versa. Whichever one that happens, you can switch in between them, and then you have a sense of security going forward. So with dividend investing, there's a lot that you can gain, and for the most part, you also are hedging against inflation when you're investing in dividends, because when you get those dividends and reinvest them, it's like you are earning interest on your investment, and you're taking that interest and reinvesting the interest again. So even if the interest rates go up or inflation goes up, you are already hedging against that by reinvesting your dividends or investing in dividend-oriented companies. The other thing is, investing in dividend companies gives you a sense of security in terms of risk. Dividend-oriented companies are usually stable. So when you're investing in dividend companies, you know this company will not drop out of nowhere unless otherwise something has gone horribly wrong. So that sense of security in terms of risk management is kind of guaranteed, because if you look at a lot of dividend paying companies, most of them are usually very stable. They're not affected by market volatilities. They're not affected by market conditions and economic conditions. A lot of them have that in mind by the time they're deciding to pay out dividends. They know we need to be stable enough to provide dividends for our shareholders, and that goes into how they structure their company, how they structure their management, how they structure the way they do business. Because if they get it wrong, the company will collapse, and then things will go wrong for everybody. So for the sake of everybody's peace, they try and do their best to keep the company focused on making sure that the shareholders are taken care of, the company stays afloat, everything is working as clockwork, keep churning in more profit and doing a little bit more every year, and that's their goal. A company like that has focus, has direction, has a sense of, they want to grow and all that. So it's a good company to invest in because it will grow slowly over time. Now, you might be wondering, what do we do? What is the first step to do when you want to invest in a dividend company? Or how do you find some of these dividend oriented companies, and how do you invest in them? Well, these are just like regular stocks. So when you're going to when you go to screen for stocks, what you need to do is specifically choose dividend on your screening criteria. So with our stock screening website, Finviz, you can go there and have chosen there, like, what value of dividend are you expecting? And I've touched on this before, that a good amount of dividend you should be expecting is at least 3%. So you can select that 3% or more. And then we want to do an average, a current volume of, let's say, 500K. We're doing a price of $10 to $50. And then, as you can see, we still have 148 on our list. But then now we want companies that make profit over time. So this is where you go to the fundamentals tab, and here you want sales growth quarter over quarter. This needs to be positive. Okay, so that means they're making profit every quarter. Then EPS growth in the last 5 years, that is earnings per share. it needs to be positive, meaning that the earnings per share is positive and growing in the last 5 years. So you say positive there. And then EPS growth next year, that's projections for next year, it needs to be positive too, so that you're trying to get the more growth oriented companies. Then we want sales growth in the past 5 years to also be positive, meaning they're making more sales, they're making more revenue over time. So that needs to be positive. Then what else? Let me look around. This is price to sales ratio. Not really. Current ratio is a ratio of liquidity measures of a company to pay short-term obligations. That needs to be positive. That means it's a company that has cash at hand or can be able to at least afford to pay their current obligations. So a company that has more cash at hand is a good company to invest in, because they know if we don't take care of our basic operations and end up taking loans to take care of this, it will reduce our overall profit and therefore reduce our overall dividends. So you want this to be positive, so, or at least over 1, meaning it's at least positive. High is way higher, but you want it to be over 1 to make it positive. So companies that have that have good outcomes. Now, when you've done your filtering, you can see you have quite a number of them. 11 is a good number for a watch list. You put this on your watch list, and then now you go and look into them a little bit further. Now, the first on the list here is American Eagle Outfitters, AEO. So we can look at that on Team Trading View and see what the chart looks like, see their payouts and all those other good stuff. And you can see this is a weekly chart. Let me put a daily chart right here. Do this, zoom in, zoom out. That's general stuff we always do. So American Eagle Outfitters is a consumer, what are they called? Consumer stuff. Not cryptos. It's a consumer cyclical. They do apparel, so they sell mostly clothing. It's a clothing shop. American Eagle Outfitters has been doing dividends every quarter, so they paid out 18 cents back in March. They paid out 18 cents back in December. They paid out 18 cents a share back in October, and the same goes on back in time. Now, we want to look at this section right here. Let me just bring this to the side like that. This is the section we want to look at, and you can see the dividend yield. Maybe get this way. Too much. So the dividend yield right here is 5.72%. That's a good dividend yield. So like I said, you're looking for something that is at least 3.5% or at least 3. So with this giving us 5.72%, you're really doing good at the end of the day in terms of dividends. Now they pay the dividends, I think, quarterly, which you've seen in a period of 1 year. There's like 4 dividend payouts. So this is a good dividend investing company. Now, when you go to your stock brokerage account, you can search for American Eagle Outfitters and buy that stock. Now, what should you be expecting when you buy a stock with these metrics? That's where we go to our calculator. Remember this buy upside calculator website. In this website, when you go look for calculators, last time we talked about stock return, where we were calculating how much a stock can give you in terms of return. But what we want now is look at something like this, dividend reinvestment calculator. And with this, we can calculate how much you can invest to earn how much in dividends. And we'll give you a rough idea of, if I invest in this company, what should I be expecting? And is this doable for me or it's not? So as it is here, it's already put in 100 shares and the stock price is 100. So our American Eagle Outfitters stock price is $12.96 right now. I think that's the bid, and the ask is at $2.74. The bid is at $2.74. The ask is at $12.96. So average price, I think it's right there. Let's use the $12.96 as an average price for the moment, for now. So price here is $12.96, and then you put in annual dividend paid. So they're doing 0.18 in 1 quarter. So times 4, you get 0.72 per year. That is cents. And then dividend growth rate. Don't think we have those metrics here. Do we have? Don't think we have the metrics for that. But let's assume they're doing on average 2% growth in dividends annually. And then stock growth rate in terms of percent. Let's also look at what it's been performing over time and see what it looks like. Go there. So it's ranging between 10 and 40. So we're looking at around 25% or less. So let's just assume it's doing, let's say, 10% growth a year. Okay, not really a lot. And now you're looking at how long do you want to invest in this, and let's say you want to do 5 years, and we do the calculation and see what it looks like with those numbers. So here it says that your total value of your investment will be $2,595 in 5 years. Your shares will grow from 100 to 124, and your dividend payout overall will be 421. And then your annualized return will be 14%. So right off the bat, if you just invest in American Eagle Outfitters and you do dividend reinvestment, you are doing 14% a year, which is way better than a lot of the circles and money market funds are offering. Most of them, if you're lucky, you know, to get 12, you'll be a miracle. Most of them are doing 10, 10.5, 11, 9, 9.5. So if you get a 14% a year performance, you're really doing good. Now, if you don't do the dividend reinvestment plan, your account will grow to 2,469, and then your number of shares will remain the same because you're not reinvesting the dividends. And then the dividends payout in that time frame is $382, and then your annualized return is 13%. So look at the difference. With dividend reinvestment plan, you're doing 14.9, almost 15%. Without, you're doing 13.76, almost a dollar plus, not a dollar, but 1% point something there difference. So this is an example of how you can figure out if these outcomes are good for you when you've screened for a stock, you found your stock right there, and then you've taken that stock, you've calculated, you've seen the dividend payouts, and then you've gone to the dividend calculator and you've seen how much growth and dividends you should be expecting at the end of the day. So think about it this way. If you are doing a dividend portfolio and one stock gives you 14%, could you imagine if you have another one that gives you 20%, another one that gives you 15%, another one that gives you 32%? If you do an average at the end of the day, it will be way better than 14% a year. So you're looking at probably, an average of around 20-30% a year, which is a lot better than what is locally available. And you can do this right from your investment account. You don't need special softwares. You don't need special access and websites. As you can see, all these websites that I'm using, Finviz is free, Buy Upside calculator is free, TradingView is free. You can access this and you can do your research and figure out your investment strategy and goals. So that's how you go about finding a stock, a dividend stock, investing in a dividend stocks, and figuring out how much you can earn from that stock. Now, that aside, we want to look at something else. We've been talking about ETFs and index funds recently, and one way of doing, say, long-term investing, you want to invest in ETFs. Like I had indicated in the previous webinars, that ETFs will give you better outcome for mostly long-term investing. And if you're searching for ETFs, you can either use the ETF database website, etfdb.com, or you can still go to Finviz, and here you go to descriptive, is it? And on under industry, right here, you change that to exchange traded fund, which stands for ETFs. So when you select that, whatever results that will come out will only be ETFs. And now, given that so as you can see, part of the reason as to why we're doing this is to make sure that we are back to square zero in terms of filtering, and then we can start filtering from there. Okay. So with ETFs, they usually don't have sales growth and sales like revenues. They usually don't have a lot of things when it comes to fundamentals. So what you want to do with ETFs is look at other metrics that affect or that work with ETFs. And I think price to earnings ratio is a good one. So we want something that is profitable. Okay, so price to earnings ratio. Not doable. Okay, that's not working. Price to sales, I don't think ETFs do that. Let's go to descriptive. I think we can find something here. Let's change the dividends to something like 5%, see what we can get. Trying to reduce the number from 300 to less than 300. Maybe around 10, 15, 20. Current volume, we want something that has a little bit of volume. Remember, reason as to why you need volume is for liquidity purposes. That is, if you buy this ETF and you want to sell it tomorrow, can you sell it tomorrow? If there is no volume, that means you'll have a difficult time selling it, and therefore the liquidity aspect of the trade won't be good for you. So we want something that has a little bit of volume, let's say 200K, and that reduces the number to 32. Just to reduce that number a little bit, let's do 7% dividend and see what we can get. So this has reduced it to 10 of them, 11. Like before, you want to take whatever your result is and put it on a trading view and see what it looks like. So let's look at this block right here at number 2. See what the dividends look like and the likes. This is ETF. And then we want to put this on a daily chart. And you can see there's one dividend there back in December. Do they have another dividend? Probably, yeah. So I think these guys are doing dividends once a year. So depending on how much it is, let's see, what are they doing? They're doing $5. So $5 in dividends a year. That's a good dividend payout at $5. Dividend yield is at 25%. So if we come back to our calculator, so the price is at 22.44. Right here, we change that to 22.44. Annual dividend is $5 and what was that? 75 cents. I think. Okay, and then dividend growth rate. Let's assume they're doing 3%. Then stock annual growth rate, they're doing 5%. Then number of years is 5 years too. So with this calculation, we can see that if you invested around $2,200 in this ETF for 5 years, in 5 years your account would have grown to 8,462. The number of shares would have gone from $100 shares to 295 shares. So that's like 300% growth in the number of shares. Your dividend payouts in the same time frame would be $5,000 in dividends, and then your annualized return is 30%, 30.4%. Like I said, you can find companies and money market funds and whatever it is investment vehicle you're using that will give you 5, 8, 9, 10, 11, 12%. But with this just one ETF, you can do 30% a year growth. And that is, you're investing in dividends with our investment plan. Now, if you don't do an investment plan, your account will grow to $6,000, and your dividend payouts will be 3,144, and your annualized return will be 21.77%. As you can see, with dividend reinvestment, you're doing 30%. Without dividend reinvestment, you're doing 21%. So this just goes to tell you that if you have the opportunity to reinvest your dividends, you will make a little bit more than if you didn't reinvest your dividends. And as you can see here, with the dividend reinvestment plan, your total dividends is 5,000. Without it, it's 3,000. Meaning, part of the dividends that you are reinvesting earns you even more dividends. So it's like a rolling stone effect. It keeps growing the more it goes over time. So you'd want to do that. You'd want to reinvest your dividends, and instead of getting $3,000, you're getting $5,000 in dividends, which is way better than the other way around. So that's a sample ETF with these metrics. Like I said in the previous webinar, you can go here also and look at the screener, ETF screener. Under this ETF screener, you can select dividend. Okay. Under the criteria, you can select a dividend yield, and you can choose, let's say, 5 to. How do I want to put a maximum limit? Let me put the same as FinViz, 7% to. They have a maximum of 26%, 27.
Wow.
So with this metrics, we can see here that all these are ETFs that give you between 7% and 27% dividends. Okay. So from here, you can then look at each one of them and their performance. But what I would like you to do mostly is just change this sorting for the year-to-date price growth or price change, and you want something that is doing a positive price change. So something like this one, as you can see, this is a commodity ETF that deals with oil, and it has done 62% growth this year. So gives you an idea of what you should be expecting when you're dealing with the high dividend ETFs. Something that has grown by 62% within the year to date is a good growth. And then this is another commodity ETF, and right here we have equity, so stuff to do with finances, and then all those other stuff. Now let's just pick one of these and see what it looks like. So this is infrastructure ETF, AMZA, and look at it here on FinViz, on TradingView. Infrastructure cap ETF, and as you can see, the dividend yield is at 7.72%. They pay out their dividends, I think, every quarter. So this is every month. This is a monthly dividend payout. So this is May, April, March, February. So every month they're paying out dividends. So if you're looking for a monthly income, this will be a good one for monthly income because they pay out their dividend every month. And let's see how much they pay out the dividends every month. They're doing 22 cents a month. So 22 cents a share. If you want to earn, let's say, 20K a month, that's $200. So it's 200 by 22. You should buy at least 900 shares of this ETF at $33. This is going to cost you around $30,000. So $30,000 for you to just earn a $200 monthly income. Now, that doesn't really sound well, but if the dividend payout was a little bit more, maybe $1 or so, then it will make a little bit of sense. But this, in combination with other dividend ETFs and stocks, can really raise your overall monthly expected income from dividend ETFs and stocks. So yes, this gives you a monthly dividend, but still is a little bit low in terms of the dividend yield. You might want something that is around 15 to 20% dividend yield, and with that you can earn a little bit more on a monthly basis when you're looking at income-oriented dividend investing. So that is one of the results we got from the ETF database screener right here, and that was the AMZZA infrastructure ETF. So you can keep looking for more and do the same thing over and over until you find the best that will work for you. So overall, that's the whole process of finding this dividend-oriented stocks and ETFs. And you can also change here to just say you want to look at dividends and see, how often do they pay dividends, and what dividend percentages are they doing. So right here you can see this one gives dividends quarterly. This AMZ gives out monthly. This one gives us semi-annually. This gives us every year. This one gives us every monthly. So let's say you're doing the AMZA with the JEPI and the HIPS and the XYLD. Combine all this, you can get a good monthly income out of that, because they all pay out their dividends on a monthly basis. But if you just want the top performing dividend oriented ETFs, you just sort here by dividend, and it should list them based on the highest dividend payout to the lowest dividend payout percentage. And you can see here the second one from 26 is 21, then 20%, and then 14%, and then the rest goes on like that. So if you're looking for income from here going up at around 10% going up, these are the ones that you should essentially buy. And then depending on how often they pay out their dividends, you can schedule your dividends in such a way that you can either get your dividends on a quarterly basis, and then know that, yes, I'm earning, let's say, $200,000, 200,000 Kenya shillings in dividends, and I'm going to spend that 200,000 Kenya shillings in the next 3 months before I can get another dividend payout. So you can plan yourself and know, if I'm earning this much in dividends, how much can I spend, or what is my expenses, how much is my expenses, and is this going to take care of my expenses if I divide the value into 3 months? Every 3 months I earn this much, and you keep doing that. You're budgeting, your personal finance stuff. Once you structured your personal finance, you know how much you need, you know how much you can divide however much you're earning, and this will give you a good way to live a life where you're not worried about where your next income is going to come from, or if you're going to have a job tomorrow, or if you are on vacation, or if you want to go on vacation, or if you want to take your kid somewhere for something. Like, stuff happens in life where you might not always be at work, but having a passive income like this can really take care of you when your regular income is not coming in. So you're not worried that if I don't go to work, I won't pay my rent. You're not worried that if I don't go to work, I won't pay my kids' school fees. If I don't go to work, I won't be able to afford my living expenses for this whole month. And then you have to take these shady loans and other things, debt from friends and family and all that, to just give you that sense of security in your investments. Invest in a dividend, create a dividend portfolio. Like this list right here would have been a good list, except for for the oil right here, I don't think that's just recently because of Russia, Ukraine, but otherwise, the rest are good. They look like good companies with good ETFs from good ETF issuers. I see Direction right there. Invesco, we've seen Invesco before. Van Eck is a good one. ProShares would have been good if this wasn't oil ETF, but if you are into that risky kind of venture also, this is a good one to invest in. Get those dividends right there. 26% is a good dividend payout. So to just sum it up, dividend investing is good for everybody. It's good for beginners. It's good for people who have stable jobs, people who don't have stable jobs. It can guarantee you some sort of income, some sense of security, so that you're not worried about keeping your job, or you're not worried about if something goes wrong, you have to attend to an emergency, that you won't get paid. If you have a business, you're making money, but your money, your business doesn't give you regular income. To stabilize that income gap, you invest in dividends, so that if your business gives you 10K today and 5K tomorrow, the dividends will come and balance it out, and you can have a consistent income. So all in all, try and do this. Try and create a dividend portfolio, either a 3-fund portfolio or a 6-fund portfolio. But I recommended, if you're doing dividends, maximum 10 dividend ETFs and or stocks, so that you give yourself a little bit of wiggle room, in terms of performance. So create your dividend portfolios, invest in dividends, look around and see, what can you make passively where you don't have to go to work to earn your living. And I think with that, we should be good. I was looking at this when I was preparing for the webinar, and if you go to the ProShares ETF website, they have strategies where they can even give you a combination of dividend-oriented ETFs, and you can use that to create your own dividend portfolio. So like here, these are dividend growers, so where they grow dividends over time, good growth over time. And if you invest in this Noble, NOBL, REGL, and SMDV, like I said, 3-fund portfolio right here is a 3-fund portfolio. You use this portfolio, you put these ETFs in your portfolio, and you can have a dividend growers portfolio. This is good for long-term investing, where you're not you're doing dividend reinvestment. You're not taking out your dividends, and you're not worried about accessing this money in the next 5 to 10 years. So you can just create this 3-fund portfolio with these 3 dividends, right? These 3 ETFs right there, and it will grow your account over time. Maybe I should I will do that a little bit later on, where I'll put this in a sample 3-fund portfolio, look at it from, let's say, 10 years ago, and see the performance, and maybe post it on the group. But so far so good. We've done almost an hour of this webinar. I like keeping it that way, and I'm going to open up the floor for questions right now. If you have any questions, let me hear your questions.
How is one able to screen for a good stock that will give a stable dividend for maybe a period of 5 years?
For a 5-year period, is this here? Okay. So when you're doing screening, what we use for screening for stocks, you come here on this website. It's called FinViz. Under FinViz, you select the screener tab right here, right? Then under the screener tab, you'll get a bunch of things going on there. But one, you're looking for dividends or dividend-oriented companies. So right there's a dividend yield where you choose how much, what percentage of dividends are you looking at? Are you looking at 5%? Are you looking at 10% or more than that? So say you're looking for maybe more than 10%, more than 5%, you select over 5%. So all these companies, all these stocks in this list will give you at least 5% in dividends. And then now you want, say, for the next 5 years. And that's where I had indicated that when you're doing the fundamental analysis or fundamental criteria that you're choosing, look at the earnings per share growth in the last 5 years. This is a good indicator that in the next 5 years, they might probably do the same. So if they have a positive earnings per share in the last 5 years, there's probably going to have a positive earnings per share in the next 5 years. So with this, you select positive, meaning you're expecting them to have a positive earnings per share in the last 5 years, which will reflect that in the next 5 years, it will also have a positive earnings per share. Same to the next 5 years, EPS growth in the next 5 years. This one also, you select positive, which gives you a positive earnings per share in the next 5 years projection. And then the other one is sales. You want something that has good or positive sales. So with this one, we select also positive, and this will give us a positive future or expected in the past 5 years, and then we find the one that will do for the next 5 years. But I don't seem to see that. With that, you can do the quarter growth, quarter over quarter should be positive. So as you can see here, you still have 83 companies that have positive past returns and positive future returns or expectations. And then the reason as to why I'm doing EPS is because EPS stands for earnings per share. If the earnings per share is positive, that means it's growing. And if you're looking at the next 5 years, that should be positive for your question, that is. And now, with this list, if let's say you filter by price, okay, it will reduce that list a little bit. So you come back to descriptive and select price, and you want a stock that you can afford. So you don't want anything that is, over your limit or your capital. So if you can afford a stock that is between 10 and 50, that's what you select. If you can afford a stock that is over $100, that's what you select here, over 100. But for the most part, anything that is between 10 and 50 is good enough for investing. So you select that, and it should reduce that to 66. And then you want something that has a little bit of volatility and liquidity. That goes with volume. So current volume, if you're doing something like over 500K, that means it's very liquid, very, very easy to buy and sell. You don't buy and hold it for too long if you want to sell and all that. So that gives you a list of around 18. And this is a list of companies that have dividends and have future positive dividend expectations. So that's how you screen for dividend companies and stocks.
Which is the best strategy to approach maybe trading in these stocks? Because some of these stocks could be they cost quite some money. There's one that you've just given an example that goes for around 30. Is it $30 or something?
$33.
$33.
Yeah.
And you to like get to a point whereby you're able to get a passive income of let's say 20,000 shillings. You've talked of maybe one needs to invest like how much? Is it $30,000?
It was $30,000. Yeah, that's $3 million.
$30,000. That's 3 million Kenya shillings. And
Yeah.
now you can imagine now, like most of some of us in Kenya, having to raise 3 million Kenya shillings for a single stock.
Yeah.
It's quite an amount. So I would like to know, like, how which is the best way to begin? Just from, I'm sure you're conversant with now the Kenyan
Yeah.
dynamic of income and all that. So how which is the best way to start then as we grow now to that level of maybe investing that kind of money?
Okay, so if you are just getting started, your income ranges between, let's say, 50K to 100K a month. You have expenses of around maybe 40K, 30 to 40K a month. So meaning you're probably having around 10 to 15 to 20K to invest if you're lucky enough to have that kind of money. So if you're investing around 20K a month, the best way to get started is you get started by investing in companies that are around $10 to $20, and you invest in these companies for what I call swing trading, which is short term. You buy a company today, you sell it in 2 days to 1 week, sometimes even a week plus. So you buy them, you sell them in within 2 days, within a week, then you keep growing that. So if you can start with 20K, which is $200, you'll be able to buy a company that is $10. And that means you're buying 20 shares of that company. And then your aim is to make something like around 10% in that stock. So your $200 will go to 220 in like 2 days. And then you take that 220, you buy another stock that will do 10%, and that will go to around, let me see, 220. So 220 will go to 242. You do the same again the third time, 242 will go to 292, and you keep doing that. So within that 1 month, and say you're doing on average something like 7%, maximum 10%, but 7% every 2 days. So you're doing around 2 or 3 transactions a week. Okay. So in a week, 7% will earn you around 21% overall. And then you're doing that for 4 weeks to do a month. So starting at 220, at the end of the month, you'll end up with something like 471. And then you add another 20K. So you take that 20K, you add that to the existing amount on your account, you get 671. Then you take that 671, you compound it the same way. Yeah, doing around 21% a week, 10%, 7 to 10% a day, or 7 to 10% every 2 days. Your 600 will go to 1400, and you keep doing that, and you realize that if you do this for, let's say, 1 year, without you touching that money, just compounding it, do it for 1 year, you'll end up with something like 10, 15, 20K. If you're consistent, if you know what you're doing, give or take, maybe let's say 10K. Now, when you get to that level at around 10K, which is 1 million, that is, you've been investing for a whole year, 20K a month, that's 240K. That's just the investment you're making, and then if you're doing now the compounding at 20% a month. Let me see that. So 20% a week, not a month. So 20% a week, meaning per month, that will be around 80%. The numbers are going to be crazy. But what I'm trying to say is you keep doing that, compounding it on a daily basis or every 2 days, and then compound it on a yearly basis. Your 240K invested will probably end up being around 900K or 1 million. Now you take that 1 million and then now you invest in dividend ETFs and stocks like this. There is on the previous webinar I had a dividend what is this? Yeah, this is a dividend portfolio. So in this dividend portfolio, you can see this is a 10 dividend oriented ETFs and stocks, and then each one of them is around $1,000. So if you have $10,000, you can buy $1,000 of this, $1,000 of that, $1,000 of this, up to 10 of them. And then now, when you look at how much is this going to earn you, this is a very highly filtered portfolio. That is, whatever is in here is really good in terms of performance. This will give you around 6.7% dividend yield, a return of around 31% annually, and in the next 12 months you will earn around $2,000. So this could be you 1 year from now, doing 20K every month investing, compounding that by around 10 to 20% every week, and then targeting 10K, which is 1 million. Once you're at 1 million, you come and create a portfolio like this. This portfolio will then be earning you $2,000 in 12 months. So it's not a lot, but it's something. So $2,000 in 12 months, you're making around $166 a month. That times current dollar rates of say 115, you're making around 20K, just like that. So you don't need 30K to achieve the 20K outcome. You don't need 3 million to achieve the 20K outcome. You can do it with 1 million, investing in such kind of portfolio. And then you can see here that with this portfolio, if you keep reinvesting the dividends, in the next 4 years, your dividend per year will have grown to $4,000 from $2,000. So if you're doing $4,000 per month, you'll be doing around $333 times the dollar rate right now conversion. You'll earn around 38K a month with this portfolio. And total dividends in the next 4 year period, you're looking at around $10,000, which is 1 million. So you start with 1 million 1 year from now, after slowly investing over time. 1 year later, you have 1 million. Take that 1 million, create a dividend portfolio. That dividend portfolio will earn you around $4,000 every year from 5 years from end of the year, that is. And then in total, from now to the next 5 years, you would have made another 1 million in just dividends. And then what does it look like? If you've made 1 million in dividends, you've made another in growth, that means your portfolio after 5 years will be worth $33K, which is around 3.5 million Kenya shillings. And now with this 3.5 million Kenya shillings, you go create three other portfolios like this one, or you just add whatever you've earned into this portfolio and keep growing it. But you can bring it down again to 10K, this portfolio to 10K, make another portfolio of similar performance, and now you have three portfolios that gives you around 40K every month. And now you'll be earning around 120K a month with that. And that's like a 5 to 10 year period plan. And then if you're looking at retirement in the next 10 years, that would be perfect. You'll be earning around 120K a month. You can comfortably retire, and you know for sure that if you leave that money there, it will take care of you for the next however long it will take. So that's just the strategy you can use to invest like you had asked.
Thank you very much. I think that's quite practical and quite a challenge to not just me but everybody to it's something that someone we need to try out. Thank you very much, Alan.
Yes.